Let's take a young guy, someone who's 25, 30 years old, who's just started his first job. He's got a nice 30, 40, 50-year kind of time frame to achieve his goals, his life. Let's simplify something for him here, Vidya. What would be your advice to him for someone who's just starting it off? Probably you could help us on the asset allocation side, and then within each asset, what would your recommendations be?
Right. So, for a young investor, whether somebody is young or old, there's only one thing. They don't need to do too much assessment of their own. I mean, if you were to go the traditional route, you do a risk profiling, you understand the age, you understand the commitments, etc. But that's a full-fledged way of doing it. But very simple thing to start with is, let me just set some time frame for this investment. Do I need this money in 3 years or 5 years, or I need it much later in 10 years or whatever? Just one simple time frame or goal to your investing. Or you could have two different goals. I need some money for within the next 3 years, I need some money much later, say after 10 years. Once you decide to do that, the path becomes very simple and clear. If you have a very short term goal, simple thumb rule, keep your equity lower, simply because equity can deliver negative returns, can deplete your portfolio in less than 3 years or even up to 5 years. So what do you do then? You keep the equity portion less if your time frame is less, and you keep the debt portion more. Now for this person, let's assume that they have a 3 to 5 year time frame. Probably a 25-year-old who wants to probably do an executive MBA maybe when he's 30 or so. So 3 to 5 year time frame is not too much time for me to go all out on equity, but at the same time not too bad. So they could very easily have a very simple balanced 50-50 portfolio, right? 50% in equity, 50% in debt. If you fancy gold, then maybe a 10% in gold and keep your debt to 40%, right? Not every investor wants to invest in gold, but gold can be a good hedge in when the equity market is volatile. Now once you decide this 50-40-10 or a 50-50, if you're a do-it-yourself investor and you're new to the markets, don't go and try complex products. You have very simple products in the mutual fund space today. Once you have already, and before you do this mutual funds, just make sure you have taken care of your tax saving need, starting with a simple product like PPF, right? That will kind of keep it going, and it will ensure that you earn steady returns over time. There is no volatility. Once you're done with it and you want to save this in equity, you should start with very simple products such as passive equity funds. When I say passive equity funds, these are funds that will mirror the index. Here there is no risk of your going wrong, simply because there's not going to be any active call by any active fund manager. There's not going to be any kind of active call in terms of you getting the fund grossly wrong. For example, if you take the large cap space, you have just a few indices that reflect the large cap stocks, which is the Nifty 50, the Nifty 100, or the Sensex. You could choose any of them. You simply need help in terms of choosing the slightly optimal one. When I say optimal, that they mirror the index as closely as possible. That means they have low tracking error. A platform like ours will easily help you choose that. So you could simply pick a Nifty fund for your equity, and if you would like a little bit of risk, you could add maybe 10% to 20% in Nifty 500. So let us say I just started with a 30% in Nifty 50 index, which is a large cap index, and maybe another 20% in a broader market index, which has large mid cap and small cap, which is the Nifty 500. Now I've already got my 50% right. In my debt, 3 to 5 year time frame gives me a good time to mix both short duration and slightly medium duration as well. So I can easily mix a floating rate fund or a short duration fund plus one simple no credit risk corporate bond fund. Now, with these two and any gold fund with low tracking error, which again, you can refer on a platform, you are good to go. You do not run the risk of underperforming the market in equity if you simply hug to passive funds. So the risk of you going wrong with your decision or somebody else giving you a wrong fund is entirely removed here. So that's the way to start if you have absolutely no idea. Naturally, an index fund may not outperform the market, but it will ensure that you are with the market. So this is a 50-40-10 or a 50-50 simple portfolio that you can start with. If you have longer goals like retirement, you can make it 60-40. Slowly you can, if your risk permits you, you get comfortable with the market, you can go even up to 70-30 in equity debt. So that's the way to kind of very gradually increase up your risk. Many people do this mistake of starting out with a very high equity portfolio, thinking that they are young and they would have been told that they can take risk, but many of them cannot. So they are unable to handle the risk. I knew of an investor who, in the peak of 2020 COVID, an young investor, maybe 26 or 27, who decided to go all out on equity because, the market was booming and they thought they made enough money. But last year, in 2022, when experienced correction, he could not handle it at all and he decided to fully exit, took every bit of the money that he had invested very well. And because it was falling and he thought it was going to fall like bitcoins, and
Hmm.
therefore he decided, he can't handle this, and instead of actually averaging in the market, he decided to exit and put it in FD at 6%. Now these kind of decisions happen because you don't have a balanced asset allocation. If you had put, say for example, started with a 50-50, your portfolio hit would have been much lower and you would have gotten decent positive returns. So that's, although debt didn't do well either last year, but at least it would have helped you from uh, seeing your capital being eroded. It could have avoided that. So these are small mistakes that young investors make.